Cool. So Palantir just posted 63% revenue growth, and the stock dropped 8%. Microsoft crushed earnings, and they brought in $77.7 billion in revenue. Azure is up 40%, and yet the stock fell 4%. Tech just essentially had its worst week since April. The NASDAQ, as of right now, has dropped about 3 to 4%, and today it is still happening. And the kicker is nothing has actually changed. Nothing about these businesses has fundamentally changed, and yet we are seeing red all across the board. We are watching essentially what I call one of the most predictable patterns in market history playing out in real time. And if you have not read the title here, this is buying the dip. So you know exactly where I'm going with this. But again, this is one of the most predictable patterns in stock market history. It's happening in real time. And I am very confident that pretty much every single person here has thought about it and or did something close to it. Right now, the algorithms that we have set up and we built into place are saying buy, buy, buy. And yet retail investors, aka regular people, are frozen right now. They are frozen with fear. And the kicker is just that institutions, aka all of Wall Street, they are scooping things up like it is a Black Friday sale right now. So let me be clear about where we are going with this right now. These companies that reported earnings over the past few weeks have absolutely crushed it. Absolutely crushed it. They were not missing targets. They were beating them. And on top of that, they raised guidance and they're printing more and more cash. But their stocks, at the end of the day, are still getting crushed right now. This, when you are an investor, this is what opportunity looks like. It's ugly. It's uncomfortable, but this is exactly where real money is actually created. Most people think that like, oh, you make money when you wake up every day and it's just green. No, you make money when you are buying things on sale. You are getting the lowest price possible while everybody else is out there panicking. With that said, what's good, everybody? This is the, I think, 10th episode of the Benson Report. I'm your host, Phillip Aubrey, and I'm also the CEO of Benson AI. Quick context for people that are new here. Benson is your AI investing app that essentially does all of the investing for you. I'll say that again. It does all of the investing for you. The research, the buying, the selling, the reinvesting, the monitoring, all of it. It does it all for you. And the Benson Report is where essentially I come on every Tuesday and Thursday to talk about what's happening in the market, how does this impact us all, and more importantly, what we're doing on our end to make money off of this. We are excited about what is happening right now. I cannot underscore that enough. I am incredibly excited about what's happening right now. And of course, using AI, we're spending a lot of time decoding a lot of the data that is rolling in. And I just thought today was a perfect day to come in and share some of this information. We're going to go over 3 simple things. First, why great companies are getting punished for being great and what's actually driving this sell-off. 2, the psychology that makes buying dips nearly impossible for most people like you and I here. And 3, how to tell if this is a buying opportunity or a falling knife. For those that don't know that example, in the investing world, there's this thing called a falling knife. You never want to catch a falling knife because a falling knife is falling and is going to stab you. So you don't want to catch that. What we're saying here is just that how do you know if this is a falling knife or is this a buying opportunity? Of course, in my head, this is a buying opportunity. We're going to go over all of that today. But I think the most important thing here is just that we are not seeing companies fail. We ultimately are seeing investors panic. And that gap between perception and reality, again, that is where the real money is made. But before I jump into it, there are 3 ways for you to get involved with Benson if you are curious here. 3 simple ways. Number 1, you can go straight to your iPhone and download the app. Just type in Benson AI. That is going to be the biggest bang for your buck. You are going to have an AI that is doing all of your investing, buying, selling, monitoring, reinvesting, all of it for you. The second way is that if you are on an Android or you're not in the United States, you can simply sign up for the newsletter. Every month, you are going to get our top 10 stocks, the same stocks that everyone on Benson actually gets. You're going to get those emailed to you directly. And you can subscribe to that. That's specifically for people if you are on an Android or you're not in the United States. And the third way is that if you are, penny pinching right now and you're looking for something like completely free, go to the website, meetbenson.com. You will see a little button right at the top that says free stock ideas. We're going to share with you 3 ideas. And these ideas we, shared with people on Benson 6-7 months ago, but nonetheless, we still think are really good companies for you to go and look at least. So those are the 3 ways to get involved. Again, the first one is go ahead and download the app. That is where the AI is going to do all the work for you. The second way is specifically for Android and non-US people. Go get the newsletter. You can subscribe and get the same 10 stocks emailed over to you every single month. And then 3, if you were saying, hey, I want to do something that I will have to do all the work with, you can go ahead and actually just click the button on meetbenson.com that says free stock ideas. We'll still send you some ideas because we are that confident in our research. Now, with that said, headline number 1, the great disconnect. Why beating expectations is simply not enough. That's exactly what we're seeing right now. So what actually happened? Let me paint a picture of these past few weeks of insanity. Past few weeks of absolute insanity. Palantir came out. We all know who Palantir is right now. Everybody either loves or hates the company. It depends on whether or not you own it. If you own the company, you love it. If you don't own it, you absolutely hate it and you've been sitting on the sidelines. Palantir came out and announced that they brought in $1.18 billion in revenue. I'll say that again. They made $1.18 billion. That is up 63% year over year. And on top of that, they beat Wall Street estimates. Wall Street thought that they were going to bring in, I think, $4.17 billion. They brought in, Wall Street thought that they were going to bring in $1.12 billion. They actually brought in $1.18 billion. And on top of that, they raised the full year's guidance. What that is in simple terms is Palantir is coming out and said, hey, we told y'all for the entire year of 2025, we were going to make around $4.17 billion. We were wrong. We actually think we're going to bring in $4.4 billion. And on top of that, they are expecting their free cash flow to hit about $2 billion. And with all of that said, the stock still dropped 8%. Imagine you coming home with straight A's across the board in every class, and your mom and dad are like, this ain't good enough. Why are you not summa cum laude? Like whatever it is. Like, you come home with a report card that says A+, 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 A+. And your parents are like, I don't care. This ain't good enough. That's exactly what's happening right now. Another example of this same thing. Microsoft came out and delivered $77.7 billion in quarterly revenue. Those are large numbers here, but essentially in 3 months, Microsoft made $77.7 billion in 3 months. Azure, which is their cloud hosting service, is up 40%. Versus they thought it was originally going to do about 30%. And yet the stock dropped almost 4%. Again, the scoreboard is very clear right now. NASDAQ is down 3 to 4%. The tech side of things just had its worst week since April. But again, if you were an investor in April, you have been handsomely rewarded. For the people that were investing in April, especially the people on Benson, if you were investing in April, you learned a hard lesson very quickly and you profited off of it. In April, the stock market fell, I believe, 17%. That was again around the time that Trump came out and said, hey, I'm going to tariff the entire world. Stock market fell within the 2 or 3 days. It fell about 17%. Everyone at Benson decided to increase their weekly budget and continue investing even more money. Stick to the plan was essentially the message that we were saying around that time. And then more importantly, within 30 days, the entire market had rebounded. Within 60 days, the market had hit all-time highs. And within 90 days, we were hitting all-time highs about once or twice every other week. But again, these are some of the things that it's hard to see when you're in the midst of it. And that's exactly why we're sharing this information right now. The real story that I think that nobody is talking about right now is that Palantir, it is expensive from a fundamentals point of view. It's trading at 230, almost 40 times its trailing free cash flow. The P ratio is also incredibly high. And as a result, people are looking for any excuse right now to essentially take profits. And it makes sense. When you are a short-term investor, all you care about is taking profits. I get it. But if your goal is to actually make money here, you have to transition into a long-term investor. The data supports this day in and day out. Short-term investors generally are losing money over the course of 12 months. 90% of short-term investors are losing money in a 12-month period. 90%. But again, back to this thing here. I think right now, when you zoom out, let's zoom out. We're talking about Palantir having, crazy high price to earnings ratios right now, and it's completely understandable. But when you zoom out a bit, in the early 2000s, Amazon spent years trading at what I define as nosebleed multiples. If you thought that Palantir was bad today, go and look at what Amazon was trading at in the early 2000s, in the 2010s. It was terrible. However, anybody that decided, just because of one metric, I'm going to sell the company, those people essentially missed out on a 10-bagger. Since 2010, Amazon has increased by 10x. Meaning, if you looked at that, just one simple number, you would have missed the bigger picture. The difference from then and now is simple. Interest rates. That's about it. Back then, the risk-free rate was basically zero. Today, after 2 market cuts this year, the Fed has essentially a range between 3.75 and 4.0. Money market funds are yielding about 4 to 5%, 4 to 4.5, almost 5%. But back in 2021, you couldn't get 1% on your savings account. Today, you are getting paid to sit in cash. That simple math around how interest rates impact all of this makes a big deal. And in plain English here, your restaurant is essentially packed. Clearly, I like this example of restaurants. I think everybody can understand a restaurant. It's really hard to talk about economic policies and interest rates when, this is not something you nerd out about. So I like to keep it simple, go over some simple analogies that really paint a picture of what's happening right now. Picture this. You own a restaurant right now that is packed every single night. Around the corner, like people are lining up to get inside your restaurant. Revenues are up 60%. Profits are soaring. But at the same time, your landlord comes back and says, I'm going to double your rent. Now, granted, you are still successful, but you now have less room for error. Ultimately, you have just been punished for being so well or doing so good at your game. And that's part of the reason why, some people just decide to buy the building rather than, having to deal with your landlord increasing your rent every 2 weeks. But nonetheless, here we are. That's just what happened. That's also what's happening with tech stocks right now. Businesses are thriving, and yet they are being punished for doing so well. And it's because regular people are looking out and saying like, this can't be true. Well, the numbers don't lie here. These companies are bringing in a lot of money. Let me tell you what's actually going on here. The reality is just that I think regular people that don't own the stock market right now are really concerned that this is looking like 1999 all over again. Stretched valuations, the AI narrative, good news essentially no longer feel like good news. Good news is now, okay, cool, time to take profit. What all the Wall Street nerds and tech nerds are saying is the complete opposite. which is that this is the first inning of the AI super cycle. Goldman and Vanguard just came out and essentially said that current AI capex is still less than 1% of GDP, well below the 2 to 5% of GDP we saw back in the time of like railroads, electrification, and the dot-com build-out. So essentially, things are looking very different when you actually look at the numbers. Both sides, I think, are missing the bigger picture here, though. It's just that there is a massive rotation that's about to happen. Money is about to go from the sidelines to being in the market. And that is exactly why all smart investors right now are buying the dip. All smart investors right now that I'm seeing are buying the dip. I pulled this data earlier today. Total money market funds, which is basically cash sitting in like something close to like a savings account, is about $7.5 trillion. Retail money, aka regular people, they just hit a record of sitting on roughly $3.02 trillion. That yields around a 4% risk-free rate. That is essentially a pile of cash that is being parked on the sidelines right now. Meanwhile, Bank of America, their fund managers just said that the cash balances for their clients just fell. Now, that may not make a lot of sense. So let me say this a bit more cleanly. Regular people are sitting on the sidelines right now. Wall Street is buying stuff up. Money market funds are essentially savings accounts. It's about $7.5 trillion sitting in savings accounts. While Wall Street right now are saying their clients, they don't have any cash because they are scooping things up now. I'll say that again. Wall Street is buying stuff up, and most regular people are sitting on the sidelines. And this is that number one problem that you see time and time again. People are going to see a stock drop 10, 15%, even though it's been up 170% for the year, and they're going to panic. The stock jumped up 170% for the year. Why do you care so much about a 10% drop? Just know that it is cheaper than what you could have bought it for yesterday. Get it while it's on sale. But we know that that's just not reality. We understand that there's a lot of psychology behind why people are it's pretty much impossible for them to say, hey, everybody else is panicking and I'm going to go and do the exact opposite. I'm going to calmly sit down and listen to the good advice that I've heard year and years over again and actually do it. Essentially, you know who buys when retail people panic? Professionals. Professionals are scooping stuff up while everybody else, all of the people on TikTok are screaming, oh my God, the world's ending. We're about to go into one of the worst recessions ever. But yet you can't support that with any data. Yes, we can acknowledge that stuff don't look good politically. That's very true. But the fundamentals behind some of these companies, completely different from what we saw in the late 1990s, early 2000s. And yet, people are still going to say what they feel. But smart people understand that you have to start looking at data before you go out and make these rash decisions. And one of the most rash decisions right now that you could possibly make is saying, hey, I think it's going to fall 30 more %. I'm going to wait. Bro, scoop up something now while it's on sale, because if you are wrong, you just missed the biggest sell all year. The sell-off right now is not about fundamentals cracking, and I want to make that incredibly clear. Fundamentals are not cracking. Plain and simple, meaning these companies are still making money. They are still saying, hey, we are going to continue building out this AI stuff. We are still bringing in more money. We are raising the amount of money we thought we were going to make. And it's because they're that confident. Higher rates making growth stocks less attractive is what's happening right now. Crowded positions in AI winners. Yes, we all know that a lot of people are essentially only looking at like 3 or 4 stocks: Nvidia, Microsoft. What else are people looking at? I guess Google right now. And short-term traders are essentially taking profit. When you combine all of these things together, you are essentially watching like regular people determine what's happening in the market, while smart money is saying, cool, y'all do what y'all do. We're about to go scoop some stuff up. Smart investors right now, again, are building their positions. So what does this mean for your money? First, stop looking at PE ratios in isolation. The only thing that a person can really say about Palantir is just that, oh, the PE ratio is high. That is one side of the entire picture. Palantir just came out and increased their revenue by 121%. They increased their revenue by 121%. And you're worried about one simple metric. You don't look at things in isolation. For high growth names, the relationship between growth rates and multiples matter more than a single absolute number. 2, every single person needs to be building their shopping list right now. If you can hear me right now, I need you to write this down. Pick 3 to 5 stocks that you love now, but you would love even more if they were 20% cheaper. This pullback may give you that opportunity to go and scoop those companies up while they are 20% cheaper. But if you just keep telling yourself that, oh, I'll just feel it when it's time to buy it, you will miss it. You have to write this stuff down. There are 3 or 4 companies that you may like. Look at their price, their all-time high or whatever price you care about and say, if it hit this number, I am absolutely going to buy. Write it down, write that number down, because when it hits that number, you need to, no matter what, say, hey, I said I was going to do this, and actually do it. Again, most regular people are sitting on the sidelines saying that, oh, the world's going to end and then I'm going to jump in. No. That's not how the stock market works. You're going to miss the sale. And 3, time horizons are absolutely everything. If you need your money in, the next few months, you're speculating, aka you're gambling. But if you're saying, hey, I'm going to be a long-term investor, I'm going to, pick this or reevaluate and look at this money again in 2030, that is what investing actually is. If you're saying, hey, I need this money in the next few months, go sit inside of a savings account. Investing is not for you. Your savings account will pay you 3-4%. And hey, maybe that's good for you, but 3-4% is not good enough for me. I won't be able to hit my retirement number if I'm bringing in 3-4%. So again, 3 things that every single person needs to be looking at right now. Number 1, stop looking at PE ratios in isolation. It's just one part of the bigger picture. 2, you need to create your shopping list. If you don't have a shopping list now, let that be the single thing that you do as soon as this is over. And 3, understand your timelines. If you're saying, hey, I need this in the next few months, you're screwed. Like, we don't care about what happens in the next few months. Your goal is to allow your money to work for you as long as possible. If you understand these 3 things, you're going to be a very happy person. Now, how are we looking at this right now? This volatility for us is a buying opportunity. It's exactly why emotions are your enemies. We have essentially looked at over 60,000 portfolios at this point. And during the last 5 tech corrections, essentially accounts that kept their investing going, and we're looking at, and when we say this, we're looking at like not our actual data. We're looking at like the Charles Schwab's, the Robinhood data. When you look at those accounts that decide to continue investing during those downturns, their portfolios did about 20% better than everyone else. And fun fact, we saw that exact same pattern for people who were investing with us during April. April was one of those months again where the stock market fell about 15-17%. And if you decide to continue investing during that period, you increase your returns by roughly 20%. It's not by coincidence. This is quite literally how math works out. So regardless of like how we feel about things, the math tells us when the market dips, if you want your returns to be higher, you need to continue buying it while it is cheaper. We can understand this from like a mathematical point of view, but when we say it's time to put it into practice, it's a whole different ballgame. And it's not because like those people that were buying the dip. It's not like, those people are just, naturally smarter than anybody else. That is not the case. It's just that those people realize that we as humans all have one simple limitation, which is that we are going to try to time the bottom. That's why when everybody asks me this simple question about like, oh, when is the recession going to hit? I'm like, bro, I don't know. Nobody knows. And if they tell you that they know, they're lying to you. Nobody knows when a recession is going to hit. So what smart people say is, hey, when it hits, I am still going to be scooping things up. What we saw again is just that those people back in April understood that that is a limitation of them trying to buy or trying to time the bottom. They said, forget it. Let the AI do the work for me so I don't have to think about it. And you can already guess who won in that time frame. Plain and simple. Plain and simple. So I think everybody is having this question right now about whether or not AI is overvalued. And I think they're asking the wrong question, honestly. I think the real story is that over $7.5 trillion is sitting on the sidelines right now, while all of the smart investors are scooping things up. They are scooping things up. Let's jump into the next thing here because I do want to try to end this on time for the first time ever. The psychology problem. Your brain essentially hates a bargain. I'll say that again. We are hardwired to hate a bargain. Let's talk about this essential failure of human psychology that is happening right now. Most individual investors have done absolutely nothing. During the moments of volatility, what people tend to do is absolutely nothing. You look outside and you're like, oh, the market is red. I'm just going to wait. That is essentially what most people are doing right now. And Vanguard just came out with some very interesting data. Vanguard, which is, one of the largest brokerages out there, has shown that essentially 90% of their investors over the past quarter did not place a single trade. I'll say that again. Vanguard, one of the largest brokerages on earth, just showed that roughly 90% of the accounts that they have did not place a single purchase during these crazy dips. That's wild. Those accounts, of course, are controlled by regular people. What you tend to see is just that during moments of volatility, regular people say, hey, I'm not going to do a thing. And that is, again, one of the worst things that you could possibly do. Right now, volatility is hitting like some crazy highs. We know that. VIX, which is a tool that we as investors use to measure volatility, is in like the high teens, low 20s. It's like the highest it's been in weeks. Option markets are putting out a lot of puts right now, over calls. And then this one is actually interesting. Over the past, I think, 2 months, the phrase market crash has spiked up roughly 300%. Combining all these pieces of information, the traders are putting out puts over calls. Volatility is crazy high. Regular investors measured by Vanguard, essentially 90% of those regular investors are doing absolutely nothing. And people are Googling market crash, up 300%. Said otherwise, regular people are terrified of a 10-15% pullback in companies that have already doubled. And I know that some people are going to think I'm joking when I say have already doubled. I'm actually going to pull this up right now so that I can actually share one of our stocks. Actually, no. Let's actually look at what Palantir has done. Since January, perfect example. Since January, Palantir is up 143% as of today, even with the dip. Robinhood is up 256% since January. And you're on the internet and you're going to hear people panicking about the stock dropping 10, 15%. Who cares? The stock has jumped up 143%. Why are you panicking? Calm down, bro. That is not how this game goes. You should understand. And if you don't, understand this now. When the market dips, that is your opportunity to scoop things up while they are on sale. But that is not what's happening right now. Regular investors are terrified about a 10-15% correction when these stocks have more than doubled since January of this year. And sometimes like over 5x over the past 2 years. It doesn't make sense. But again, we're hardwired for pain. A perfect example when I say we are hardwired for pain, and this is, I'll connect the dots at the end, but I actually want to ask a question. I actually want to ask you a question. And I want you to respond in the chat here. So like put the phone down and get ready to respond. Which do you prefer? Which do you prefer? Do you prefer to find? Actually, let me think about how do I phrase this well, because I want you to actually think about this. Basically, that's a good one. That is a good one. I'm gonna come back to that one. I wanna work on that. I'm gonna come back to this example. But essentially, right now, what we are seeing is that people are overreacting to some very minor adjustments in the market. We know that the market does not go up every single day, but when you are new to the game, or you simply just hate technology, or of course you're upset about what's happening in the country, rightfully so, you're looking for every excuse to really clutch on to the fact that, you know, something is going to break and the world's going to end. And this is where I think it's really important to have a framework to abide by. There are two types of market dips, and knowing the difference is going to either make you a lot of money or cost you a lot of money. There are only two types of dips. Every investor knows this, so I want to explain this incredibly easily so that you can, take this and run with it. There are only two types of dips. One is called a sentiment dip. The other is called a fundamental dip. A sentiment dip is where people are fearful without facts. Valuations are stretched. People need an excuse to take profits. Psychology shifts, fundamentals don't. And more importantly, recoveries tend to be measured in months, not years. Combining all of this here, a sentiment dip is quite simply when people start to feel with their hearts that things are different versus looking at the fundamentals. A fundamental dip, on the other hand, is completely different. A fundamental dip is what happened in 2008. The banking system itself broke. In 2020, there were 2000, there were companies that had no revenue, but yet worth billions of dollars. The fundamentals broke. It didn't make sense. And then in 2020, of course, the pandemic, the global economy literally shut down. Those two things, a sentiment dip and a fundamental dip, are incredibly different. But again, we feel pain and we clump all of it together. So again, a sentiment dip is when your emotions say, I don't like it, the world's ending. Everybody's going to feel it. That's how a lot of people felt when Trump got put into office. And that's how a lot of people felt when Biden got put into office, or Obama for that matter. Like, that's where I hate this, world ending. I feel it. It's coming. I just know. And then you wake up 6 months later, it still ain't happened. You wake up a year later, it still ain't happened. Blah, blah, blah. A fundamental dip, though, is where the numbers break. Year 2000, aka the dot-com bubble, the numbers broke. 2008, the numbers broke. 2020, the numbers broke. That is a fundamental difference. And if you understand that, this game of saying, okay, is this a market, shifting because of sentiment or because of fundamentals? Those two things will help you kind of have a lens for what is actually happening. And right now, companies like Microsoft, Palantir, are posting essentially double-digit revenue growth. raising guidance, not cutting it. And despite what we want to believe, the US GDP is still growing. All that to say, the fundamentals still look pretty solid. But of course, I can talk math all day. We got to acknowledge that your brain is a bit different when we're talking about math. We don't think about math in our heads the same way as like when we're looking at an economy. Your brain processes losing $100 about twice as intense as finding $100. I'll say that again. You are going to feel twice as painful if you lost $100 compared to finding $100 on the floor. This essentially tells us that we as humans have this thing called loss aversion. We're terrified of losing stuff. I'd rather not lose $100 than go out and find $100. And it's why a person will drive across town to essentially save $50 on a TV, but won't buy a great company whose stock is $50 cheaper than it was last month. We are essentially wired to be wrong at moments like what we are seeing right now. And that pattern is what separates a professional investor from a regular investor. Professional investors essentially see opportunity when things are getting beat up. There's opportunity when you recognize that the stock market just dipped 2-3%. Like, oh, that means some of the best companies on earth are on sale. Why not go and buy that up? But a regular person is going to say, oh, no, it's going to fall 5% more. Retail investors essentially see danger. And to be fair, it's not about IQ. It's not about who is smarter at all. It is about whether or not you have been conditioned to look for opportunities. If you have not built the muscle of being conditioned to look for opportunities, you will not find them. You have to start training yourself to look for opportunities because opportunities do not fall on your lap. I can guarantee you, if you are over the age of, let's say, 40 years old, you understand what I'm saying right now. Opportunities do not fall on your lap. You have to go out and hunt for opportunities. You have to go out and hunt for them. That is, again, what makes a professional investor a really good investor versus a regular person. A regular person is not looking for opportunities. They're sitting on the sidelines and say, hey, I'm going to wait until somebody else figures this out. What? My favorite stock quite literally dropped 12% today. I'm going to go scoop that up right now. What do you mean? My stock that, I've done 300% with this year. By the way, I've done 300% with this single stock. Just dropped 12% today. If you're on Benson, you already know what stock that is. No, do not drop it in the chat because we are absolutely buying that up tomorrow, by the way. But yeah, my favorite stock dropped 12% today. But keep in mind, I've made 300% off of this stock since January. That to me sounds like a deal. But again, you get to this point of understanding how to spot deals when you have been building up the practice of searching for deals. Somebody said CoreWeave. You are absolutely wrong, buddy. You are absolutely wrong. And this stock has done better than CoreWeave, by the way. But I appreciate the effort there. It's not CoreWeave. But again, regular people have not taught themselves how to search for opportunities, hence why we are here. Because searching for opportunities is what will allow you to start finding more opportunities. Plain and simple. Plain and simple. I think about this for myself. And you guys have maybe heard this story from me, but in 2013, I met a guy in college. His name was Jeremy. Jeremy is actually another tech founder today. At that point in time, again, I'm a freshman in college. It's 2013. And Jeremy essentially is just like, yo, bro, I don't care what you do. Right now, I need you to go and buy some Bitcoin. Jeremy was one of those guys where he was incredibly smart. Class was easy and he hated it. Like, no joke. We were doing a quantitative, what was it? QTM, quantitative methods in math. I'm blanking on the title of the class. Jeremy was the guy that showed up 10 minutes late into class and got straight A's the entire time. And he's just like, yeah, I learned this a year ago. And I share this because what that meant was just that Jeremy was just one of those guys where he was just smart. He had worked for a hedge fund by the time he came into college. So Jeremy, amongst all of us, was just like, he's the guy. Jeremy hit me up and he's just like, yo, Phil, I know this is not going to make sense, but I need you to go out and do this. Go and buy some Bitcoin. In 2013, Bitcoin, I bought my first 2 Bitcoins for, what was it? $344 exactly. And I panicked. I panicked because it got up to 600, it dropped to 550, and I sold. And had I been smart at that time, I would have bought 6 more Bitcoins at 550 rather than selling. The next time I looked at Bitcoin was in 2017, 4 years later. And each Bitcoin at that time was worth $19,000. But again, at that point in time, I was not trained to look for opportunities. And it's painful. It is incredibly painful when I look back at that time and say, yo, even in 2017, I would have been up crazy. But look at where Bitcoin is today. Bitcoin today is like 98,000, 99,000, somewhere around that. But again, I was not trained to look for opportunities. I was not trained to understand that when the market drops and it's one of your good assets, you buy more. And somebody just said not trained and didn't have the money. No, I had the money. I was not one of the broke college students. That is, interestingly enough, I actually had a lot of scholarships. I was not broke in college. And on top of that, I had a job every semester pretty much. So I was not broke in college. I was definitely broke before college. But no, I had the money. It was just that, again, I was not essentially privy to what it means to go out and hunt for opportunities. And it's always easy to say like, oh man, I should have done that when it happened. Like 2020 is always there. But I love that response. The same person said, tried to give you a reason. This is really sad, bro. It is sad. I had 2 full Bitcoins in 2013 and sold them for $550 because I was not hunting for opportunities. It's painful. I would be an additional $200,000 richer today if I stuck to the plan. And in fact, if I was smart in hunting for opportunities, I would have bought more Bitcoin at $550. This is 2013. Like, bro, I didn't need much money at that time. I had enough to buy 2 full Bitcoins. But again, this is the reality for regular people. People are going to make this exact same mistake over and over and over again. You're going to ride something up. It's going to fall by this much. And then you're going to panic. And then you're going to sell everything. Or even worse, you're going to say, I'm just going to wait until things are all perfect again. No, bro. Your job is to hunt for deals. That is the biggest delta between a professional and, a regular person. And more importantly, right now, we're looking at a lot of data because, again, as the government is now opening back up, more data is starting to flow. And what we are seeing is that essentially, the forward 12-month stock returns have historically tended to be strong in times like this, aka interest rates going down, company profits going up, and more importantly, some sort of boom happening. Said otherwise, generally in these sorts of conditions, I'm going to answer that. Generally in these sorts of conditions, you are going to see the market do incredibly well in a short amount of time. Somebody just dropped in and said, your friend Jeremy must be rich. Jeremy is actually wealthy today. He is the founder of another startup that has been doing incredibly well. So yeah, he is also still doing very well. So with that said, rambling on a lot here, but here's your plan of action. There are 3 rules for buying fear. First, if revenue is growing and the balance sheet is clean, understand that short-term price action is mainly noise. Said otherwise, if the company has strong fundamentals, in the short term, you do not care about what they do. Again, you do not care if it's over the short term. Number 2 is that you spread out your entry points. Said otherwise, you buy often. You don't just go ahead on day 1, throw $1,000 in. Instead, you spread that $1,000 out over the course of 5 or 6 weeks. you buy portions often. And 3, if you are checking the stock price every single day, you are doing it completely wrong. Set up a system, walk away. Now, of course, if you're on Benson, all of these things are already handled for you. You do not have to do that on your own. It is all handled for you directly on Benson if you're there. But again, if you're not there and you're trying to do this all on your own, those are the 3 things that you need to understand. Number 1, if revenue is still growing, the balance sheet is strong, short-term price movements do not matter. Number 2, don't YOLO in your money all at once. That's silly. Because again, you can wake up and like today, the market drops 2% or whatever the number is, and then you're like panicking. And 3, plain and simple, you don't need to check your stocks every single day. If you are, that's probably a sign that you're very anxious. Let it go. The market does go up and down every single day. And more importantly, I think this is why we've had so much success with Benson so far. Because 1, we're doing all of this, but this is like really the key to using automation to do this whole game for you. You don't get the anxiety that takes over what you should be doing. Plain and simple. I can't underscore that enough. You're going to get anxious and you're going to allow that anxiety to determine what you are going to do. I love this comment here. I love this comment. Somebody said, the stock market seems pretty manipulated to me. I think when you are on the outside looking in, it always looks manipulated. Now, to be fair, is Trump and his buddy boys making some good money? Absolutely. Has Trump done some things that are questionable, to say the least? And I say questionable because I'm not here to talk about Trump. I think we spent too much time talking about this guy already. Has he done things that are questionable from a financial point of view? Absolutely, like dropping a Trump coin. But we're talking about the stock market here. And I think anybody who has never put money into the stock market is always going to sit on the sideline and be like, oh, no, it's manipulated. And I'm not saying that this is you. But if you think the game is manipulated, learn the rules and make money off of it. Plain and simple. If you think the game is manipulated, learn the rules so that you can also make money off of it. So I want to reframe that thinking there because, like, sure, if let's assume that thought is right, that it is actually manipulated. That means you should know how to win in the game then. While that is not true, I'm still going to say it. If it is, rigged, then you should just learn the rules so that you can also make money off of it, or decide to not make any money. But hey, in this game, in this life, my goal is to make money. And when you get into the market, you start to realize like, oh, there's some clear patterns. Great companies that bring in revenue, their stock follows. The stock goes up after the company has brought in great revenue. And if you were to like plot these 2 things out, stock price and revenue, if you were to plot those out and look at those over the course of, let's say, 5 years, with 95% certainty, generally what you see is that the revenue is going to start going up first, and then sometime after, the stock price is going to start going up after that. So the companies that do well and make money, generally, their stocks go up after. It's like this old investing phrase, which is quite simple, but revenue rise, stocks follow. That's what it was. I think it got very popular in the like 80s or 90s. I forget what investor that was. But let me jump back in here because I'm getting close with time. So where was I? Right now, there is one thing that I do think is important to go over that, is sort of like, one thing that I do think is important to go over right now before I end this, because I'm doing well on time here, so I do have to wrap it up. The Federal Reserve has been flying blind for the last few months. And the markets absolutely hate that. And October 29th, the feds came out and they cut it by another 25 basis points. And they set the target for 3.75, almost up to 4%. But right after that, we go into, or right around that time, we essentially are also in the midst of a 43 or 42 day government shutdown. I forget how many days it actually was, but like somewhere around 40 days government shutdown. And that sucks. Nonetheless, that is what happened. And what that means is just that for some time, we have been flying blind. Somebody said, the Fed is always flying blind by design. That is the furthest thing from the truth. The Fed is generally looking at lagging information. They are never flying blind, except when a government is shut down. Flying blind means you don't have any data rolling in. Now, the data that they generally look at is data from, let's say, a month ago. What happened with unemployment a month ago? What happened with consumer spending a month ago? What happened with debt a month ago? It's lagging, but no, it's not blind by design. That is not based in fact there. But nonetheless, now that data is about to start flowing again, people are on edge. And because of that, I think the feds have come out and said, hey, we got to be very cautious for the month of December because we don't really know what has happened. And it puts them in like this very uncomfortable position. And the uncomfortable position is that if they do nothing, they run the risk of things getting worse for regular people. And at the same time, if they move too quickly, other parts of the machine break. They have this like interesting balancing act to really hit. And as a result of that, Jerome Powell came out and basically said like, hey, for the month of December, we need some data. Otherwise, we are sort of at a standstill. You cannot go on running the most complicated financial instrument on earth, aka the United States government, for multiple months having no data. Now, we have found alternatives, which is we've been looking at corporate earnings reports. What happened with ADP? ADP, lets you know how many people have been hired. Or what happened with Visa and Microsoft, because those are Visa and Microsoft. I did not mean to say Microsoft. I mean Visa and MasterCard, because those are companies that give you an idea of, regular consumer spending. But they have not had, the raw, true form of data that, they are used to operating by. And essentially, that data is now starting to flow. And because of that, we are now, sitting patiently, hands crossed, fingers crossed as well, to say, cool, how is the Fed going to interpret all of this data that is now about to start flowing again? What I think is more important than trying to understand how they're going to interpret it, because at the end of the day, it is nearly impossible for us as regular people who don't have PhDs and who don't study like government and policy or balancing our balance sheets X, Y, and Z. It's impossible for us to do all that math. We also don't have the level of data that they do. So what I think is actually more important to focus on is that stocks, generally speaking, are long duration assets. Most of their revenue comes out over the 5-10 year period. Lower rates means good for them. It's easier for them to go out and raise money. It's easier for them to build factories, all of that. What I think is incredibly important for you to actually think about right now is, can you tell me, if you cannot answer this question, I want you to completely stop thinking about what the Federal Reserve is about to do. Can you tell me in September of 2000 and let's say 18, what our rates were? The question is, in September of 2018, can you tell me what our interest rates were? No. The answer is no. You absolutely can't. You can go on Google, but you absolutely cannot tell me that right now. Second question, can you tell me what interest rates were in, 2016, February of 2016. No, you can't. Why do I ask this question? I ask this question because it reminds you that none of that matters for you. That matters for the people who are trying to balance the economy. It does not impact you. Unless, of course, you were buying a house at that time or something. It does not matter for you. You being stressed about that does not help you make different decisions. If I told you tomorrow, and again, this is an example. If I told you tomorrow that I know with 100% certainty that the feds are going to come out and, increase interest rates by 1%, you're going to be like, wow, that sucks. And then you're going to be like, cool, but what does that mean for me? Nothing is the answer. It means nothing for you, meaning it is nothing for you to stress out about. Let, Jerome Powell and his group of people stress out about that. For us, we're saying, how do we stack our bread so that in the next 5, 10, 20, 30, whatever timeline it is, years, we have money that is growing. We have a nest egg sitting and waiting for us at that time, at the end of that timeline. And this is what I mean when I say, either way, regardless of what the Federal Reserve does, your goal is to continue investing. You are buying these stocks not for the next 2 months. Your goal is to buy these stocks for the next few years and allow them to continue riding their wave up. So I think the biggest thing that I had to learn for myself on this journey of becoming an investor is learning when to panic and when not to. I panic when there are things that I can control and I could do better at. I can do better research. I can spend more time reading. I can spend more time, analyzing one company versus another. I can spend more time reading 10Ks and 10Qs. All of those things directly translate to how I'm going to take action. Interest rates have never once impacted my personal portfolio in a way that made me make a decision on what I should or should not be doing. The strategy stays the same. These interest rates are not impacting you in the way that, the news or TikTok makes it out to be. Yes, there's some things happening on a macro level that we will all feel. But again, we don't have control over that. Stop stressing over it. Focus on what you can do and what you can control. There are a million things that we as regular investors simply cannot spend time or should not spend time trying to do. Because again, we cannot create value from doing that. But with that said, I think that is all that I have to rant about today. What I'll say here is let's open the floor for questions. I've been ranting on for quite some time. I've ignored quite a few questions in the chat. What thoughts come to mind? I think the only takeaway that you need to understand right now is get off of the sideline. The stock market is on sale. It is your time to get things while they are on discount. Everybody's going to pop up in 6 months, be like, man, I really wished I would have listened. Bruh, I'm telling you, now is the time. But hey, take it or leave it. Somebody said, Tall Sports Guy 2024 said, we are dropping. What are we dropping more tomorrow? Oh, no, that's not what he said. He said, we dropping more tomorrow? I'll look at after hours data right now. After hours data right now says it's a 50-50 split. But either way, the question is, are you buying something tomorrow? If the market is on sale, are you buying something tomorrow is the question that you should be asking. And the market has been on sale for the last 2 weeks. So are you buying something is the thought that I will leave with you. Tall Sports Guy said he responded and said he is buying VOO. That's fine. That's a really solid starter investment, man. So great job there. And it's also one of the cheapest S&P 500 ETFs. I think there are some better deals on sale right now, but nonetheless, I do think VOO is a phenomenal stock or ETF. Cam said, what are your thoughts on quantum computing? Cam, It is incredibly speculative. Meaning you are touching quantum computing if you're comfortable gambling. If you're comfortable gambling, you're touching quantum. But quantum has not hit its, breakout moment where the science has been proven just yet. There are still some major breakthroughs that we are waiting on. So if you are touching quantum, understand that you are essentially gambling right now. And that's okay if you understand that. But I think most people don't understand that they're gambling when they're touching certain things. And if you're gambling, be smart around how much you want to put into it. Cool. Easter said, what's your thoughts on SMCI? Super Microcomputer is the name of that asset, by the way. I used to own Super Micro. I owned Super Micro back in, I think, 2023, right when it was starting out its like crazy jump. I haven't reevaluated Super Micro in some time, is what I'll say. And it's because Super Micro, I did not like the whole missing the earnings reports or their accountant getting rid of them. They had some stuff that just really bothered me. It's really tough to be so excited about a stock and then, management just comes out and does some silly stuff. With that said, Super Micro has solid earnings based on our system, or solid ratings based on our system. Has it made our top 10? The answer is no. Is it a position that I currently hold? The answer is also no. But I haven't read their 10K in quite some time. For the year, Super Micro since January is up about 15%. Fine. That's all I could probably say about Super Micro. Entourage said, if you have X amount of dollars in a high yield savings account, what is a safe percentage to invest? That's not as simple as you think, Miss Yvonne, because it requires a lot more information. So, Miss Yvonne, I'll explain how I think about that. Your high yield savings account is the money that you need in case you had some short-term emergency. Let's say, hey, you were a government employee, and as an example, the government shut down, meaning you did not get your checks for those 40-something days. You want to be able to use that high yield savings account to pay your rent or whatever the case is, or pay your other bills, pay for groceries, X, Y, and Z. Your high yield savings account is, again, for short-term emergencies. So what that means is that you have to decide, how much do I feel comfortable in case stuff hit the fan? Miss Yvonne, I know you a bit. So I'll say, I know that your kids are grown. And if I am correct, you are you don't really have to take care of anyone. And what that means is just that, maybe you have to give your kids some money here and there. I know you're very close with your brother, but your brother is also an investor, so he does well himself. So, Miss Yvonne, the question is, how much money do you need to feel comfortable in case you have an emergency? My number is going to be very different than your number. For me, I only have a dog. I don't have any kids. I have never once in life ever had a need for more than $20,000 at once. So for me, my high yield savings account, I'd probably put it at 20, maybe 30,000. I don't know. Every dollar above that number would be invested. That's how I think about your high yield savings account. It's not just taking a percentage of it. It means how much do you need to emotionally feel comfortable? Because at the end of the day, you need some money to, feel safe. Decide on what that number is. Every dollar above that number, invest it. I hope that answers and helps you think about how to manage your high yield savings account, Miss Yvonne. Chrissy said, hey, P, I increased my weekly budget. But Webull is saying it won't be available for the next few days. Webull always tells you that as a safety precaution. If you added cash in today, it will likely be there tomorrow morning. So I would not worry about that date that they present to you. Somebody asked about RCAT. Let's look at this. Red Cat. Wow. This is interesting. What made Red Cat cross your board? You're very welcome, Chrissy. What made Red Cat cross your table? Like what do you like about Red Cat? You asked like about Red Cat multiple times. I saw it. Tell me what you like about Red Cat. You were saying you like their earnings. Their earnings were up 636%. Or WTV. I don't know what you mean by WTV. What I will say is that if you are looking at their profitability, it's pretty bad. They are also getting revisions, negative revisions, meaning Wall Street is saying, hey, we think this is going to struggle hard. However, momentum is high, meaning regular people are super excited about it. I get it. What I will say is just that Red Cat has not crossed our top 10. We don't have very strong ratings on Red Cat. But again, if you're saying, hey, I like their earnings, I like the business, management is competent, I think, they're crushing it, do your thing. I don't own Red Cat. It has not crossed our top 10. When I look at our system's ratings for Red Cat, they are not that high. That's what I would say. I get it that drones are super exciting for a lot of people, especially with, us being on the brink of war, essentially. But yeah, I don't see what you see about this 636%. Our system is not showing that their earnings jumped up 636%. I'm seeing a very different number. So if you're confident in your research, do your thing. But the data that I'm looking at now does not show that their earnings by any measure jumped up 636%. And let me actually grab the number for you because I do think this may help you out a bit. Their revenue growth over the last year is 95%, which is very, very different from the 636%. The company is also not profitable. Yeah, I would say if you like it, do your thing. But I would strongly say maybe look into that one a bit more because the 636 is not anywhere close to what their revenue has done. If that company if a company had their revenue jump up 636% year over year, it would have absolutely come across my radar for sure. Even our darling childs are not increasing revenue by that much. Like tech AI companies are not increasing revenue 600% year over year. So I'd say do your research. But yeah, somebody asked about Netflix. I think you're asking about Netflix because you are excited about, their stock split. If you have not heard, Netflix is doing a stock split. That means absolutely nothing except it is cheaper to do options on it. But you know, that's probably about it. The business is still the same. The same things matter, but it creates the illusion that it is cheaper because of a stock split. Yeah, I would say Netflix is a fine company that I personally hold. Is it one of my best companies? Absolutely not. But I do hold Netflix personally. Yeah. Solid ratings in our system as well. Miss Yvonne said, would you recommend increasing the weekly fund? Miss Yvonne, markets are down. If your budget permit, I think it's a very smart idea to increase your weekly budget. I think it's a very smart idea. If that is possible, if it's not going to hurt your bills and stuff like that, buying more aggressively while things are on sale, absolutely. Mike Moscato said, give 2 for tomorrow. I will absolutely give 2 for tomorrow. They will be directly on Benson. So if you want them, go ahead and download Benson. Now, with that said, y'all, I need to start wrapping up. It is 9:00. This is the best I have ever done for wrapping up these lives. But before I go, again, there are 3 ways for you to get involved. Number 1, you can go straight to Benson AI on your iPhone and download the app. 2, you can go to meetbenson.com and subscribe to the newsletter if you, as an example, have an Android or you're not in the United States. Or 3, if you just want some simple ideas. They're old ideas for us. Ideas that, we shared months ago, but still good and probably ideas you have not heard about yet. You can go to meetbenson.com and click on free stock ideas. I will text you myself and share just 3 ideas that, we still like. But yeah. Now, with that said, last thing is that I like to end these lives off saying good night to every single person in the chat. So I'm going to do that. Jalen Burrow said, thank you for the information. You are very welcome. I appreciate that. Yes, let me kick it off with my good nights and then I'm out of here, y'all. So starting from the top, Pam, good night. Thank you for jumping on. Parvel, good night. Chrissy, good night. Thank you for the good questions as well, Chrissy. Miss Yvonne, also good night. Thank you for the good questions. Cam, thank you for being one of the first people here. Good night. Amazing. You contributed well to this live. Thank you. Good night. Miss Hackett, good night. Lala, good night. Easter, good night. Tyrone Brisbane, good night. User 3794968910756, good night. Sid, good night. Jacqueline, good night. Neil, good night. Cece, good night. Simon says blessings, good night. Keisha, good to see you. Good night. Sermon, good to see you. Good night. Javon, good night. By the way, if you missed this live, you can go straight to YouTube. Subscribe, by the way, to Benson Report, and you will catch all of the past lives. This is episode 10, y'all. So if you ever miss these, just go ahead straight to YouTube, subscribe to Benson Report, and you will get these as soon as the live ends here. Cool Breeze, good night. Mike Moscato, good night. City Dog, good night. Spica, good night. Nicolette, good night. Special K, good night. I cannot. That's a whole different language. JC, good night. Melbourne, good night. Conti, good night. Biggs, good night. Lisa, good night. Stone, good night. Abraham, good night. Banky, good night. Keetlam, good night. Gavin, good night. Sean, good night. Nana, good night. Sassy Smart, good night. Tristan, good night. Camp Thomas, good night. Bill, good night. Chris Charles, good night. TTG Logistics Season, good night. Farah, good night. Inner Gold Daily, good night. TikTok Sparky, good night. Stay Humble 96, good night. Andres, good night. Jesse James, good night. User 99208-297-967171, good night. Big Man, good night. Big Jerry, good night. David Sunkiss, good night. Instructions and Style with Kimberly, good night. Brian DeMoss, good night. User 374 11598 532 440. Good night. Mumu, good night. CLT, good night. Eric G, good night. Eyes open. Crappy Crypto, good night. Lifty NYC, good night. Gian621, good night. Bridgers, good night. Richard Carter, good night. Corbell, good night. Dina Taylor, good night. Jason Brooks, good night. Bobby Ham, good night. Sully, good night. Sully. We Cook Official, good night. Laudress, good night. Melly, KB, Papa and Bengal, Rasul Oliver, Joe, Roger, Chad Higgins, Tamin, Andrew Middleton, all of you, good night. Belcam, good night. Reggie Thomas, good night. Danielle Lima, good night. Phoeben, good night. Pirate E, good night. Sella, good night. Noel Dixon, good night. Paul Zamora, good night. Julio, good night. Anthony, good night. Tina JH, good night. Travel with me, good night. I think I got everyone. Again, if you missed the live, go ahead to YouTube, type in Benson Report. Yes, Sermon, I am on YouTube now. This is episode 10, my guy. It's good to see you as well, Sermon. I know things have been busy on your end, so appreciate you jumping on. Miss Burrows, good night. Did I miss anything, y'all? Do I have any final questions before I break? No. I don't think so. So with that said, y'all, I will be back